Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino. I'm a financial planner with TC Wealth Management and Visa Wealth. For more information or to send in your questions, check out the show notes at treybino.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2. Let's get into the 9th episode. And this episode is on tax efficient debt structures. Oh boy, this
That
is
was
going to
a
be one of
tongue
those.
twister.
Yeah, tax efficient debt structures. What do you think we're going to talk about?
It's something exciting because that sounds like a really interesting topic.
I bet it does. So, just to before we get into it, basically, people do not understand how big of a role taxes play in somebody's financial life. And when you think about it, we spend a lot of money on taxes. You get taxed on goods that you purchase, goods that you sell. When you buy something, you get the property tax. If it's and then you get income tax on top. There is a lot of tax. And when you hear of people complaining that the wealthy don't pay enough tax, they pay a much larger percentage of somebody's income. So somebody earning, $300,000 a year will pay a significantly larger percentage of their income than somebody making $30,000 a year. What this episode is really about is, because it's such a major part of your finances, of your cash flow going out, planning around it to structure your finances in a way that can minimize that tax bill at the end of the day is a worthwhile pursuit.
Isn't there a saying, the only two things certain in life are death and taxes?
That's true. Very
I love
much
my
so.
sayings. Can you tell? Like every time I'm like, I got to give a quote of some
Yeah.
kind.
I got a saying for this. Yeah. But yeah, that 100%. And people, something that makes me laugh is, and if this is you, reframe the way you think about it. A lot of people will make decisions so they don't have to pay taxes at the end of the year. And that is a terrible way to think about it.
Oh, nice.
Because because it's just a mental thing. And you know me, I don't like things that are just mental tricks. So
Yeah.
a mental trick that people have, that when you are on a salary, that amount of tax is automatically taken off. So what people will try to do is they'll try to do RRSP contributions or something like that up to the point that they don't owe any extra tax. When in reality, the right way to do it is to pay the minimum amount of tax over your lifetime as possible.
Yeah.
That might mean that, yes, you owe tax, but you're paying tax at a 33% tax bracket. So who cares, versus paying it at a 45% tax bracket, 50%, so it's
People maybe don't know enough or don't understand all of those things for the long-term view, do you think?
yeah,
It's
they don't
just
look at the bigger picture.
yeah, it's like today I don't want to, or like maybe it's long-term, but not super long-term. Like,
It's pretty short-term thinking.
yeah.
It is, but again, that is the result of being an employee. Most business owners will just complain about tax, but which is totally fair. It's expensive, but they often don't view it as, okay, it's accepted. You're going to owe tax. If you don't owe any tax, it means you didn't make any money, so you're gonna owe some tax. It's just, yeah, trying to minimize that. And what we're going to talk about is a way that, if it's available to you, you should absolutely be taking advantage of it.
So the title is Tax Efficient Debt Structures. So I'm thinking about it. You want to optimize your tax situation using different forms of debt?
Kind of, but not
Okay.
really.
Oh, okay.
So
I was
it's
to
just,
guess.
if you're gonna have debt, it's better to have it, hold it in a way that you can at least write off the interest. So there is a line, and part of the reason we're doing this is I just did a like a skill builder for the account managers at TCU. So
Mm.
I have
The
the
slideshow.
slide deck in front of me. So so yeah, so a line 22100 is basically it's carrying charges, interest expenses, and other expenses. It's basically it reduces your income or reduces the income that you earn by the amount that it costs you to earn that income. So the line, if you go onto the CRA website, it says most interest you paid on money you borrowed and used to try to earn investment income, such as interest and dividends, can be taxed. You can write it off. So it's making sure that your mortgage or whatever that you use is structured in a way that you can write off your interest.
Okay.
And you,
So, sorry, I was just going to call to mind the name of the podcast, the Plain English Finance Podcast. So,
well, that wasn't plain English.
I mean, you did explain it a little bit better, but I'm still not clear. I'm not crystal clear yet on what that means.
I'll show you. So, for example, if I take out $100,000 loan and I use that loan to go and earn an income,
Mm-hmm.
the interest that I pay on that $100,000, I can reduce my income by that amount.
Yes. Oh, like right off the interest.
Yeah.
I do understand some.
So it's an expense, right? So think of the rental properties. We have like you have the property taxes, you have all of the expenses,
Mhm.
and that reduces the amount that you earn,
Right,
right?
because in order to do that business, you need.
It's a cost,
Yeah.
right? So, and this is the same thing in this. It's just that a lot of people don't see it as a cost because they haven't got the right structure yet.
Mm.
So a really good, actually no, on my slide deck, the next thing I went through with them was just showing the cost of it. So I gave them an example of a $300,000 loan, the rate being 4.5%. It means that roughly the annual interest is about $13,500. If this isn't tax deductible, that's what it costs them. So they get paid, they pay their taxes, and then they pay this interest cost, this $13,500. When
Mm.
something it can be written off, that's not the order of spending. You earn your income, that expense happens, and then you get taxed on the amount left afterwards, right? That's
Right.
in essence what's happening. So when it's tax deductible, the same amount, 300,000, 4.5%, $13,500 at a 40% marginal tax rate. I just kept it simple. The effective interest rate is actually only 2.7%.
Mm.
So it's significantly lower, and you get to save a bunch on taxes. I say save because this is the mental trick of if you're in a salary position, maybe you get something back if you're like paying as you go
Like, because you've
because you've
overpaid.
overpaid, but
But
it's
people
not.
like it because they're like, I have money at
Yeah,
the
it's
end
like
of
I
the
would
year.
rather owe because it means I'm not overpaying. I'd rather take that money that I
And make it work.
I lent the government for free,
Yeah.
and I could lend it to them for not free. I would even give me interest on it. I don't care.
Yeah.
But that's in essence what's happening here is you're just trying to fix that order. So
Okay.
that's the savings of doing it. I actually did a little printout for them, and just to show it different income brackets. So I did like $40,000. I did a bunch, but like 40, 100. I'll go 300 plus. So I
Mhm.
did this loan was for $450,000 at almost 4%. So at the $40,000 income, getting it tax deductible saved about $4,500 of taxes. Like that's what it reduced the tax bill by. At
Mm.
$100,000 of income, it was almost $6,000 of savings. At $300,000 plus, it was at $8,500.
Mm.
And then I also like to show the opportunity cost. So some people think that, like, I choose to think of it as there's an opportunity cost for not doing this. Like doing it this way, if you can, should be the default. And if you choose not to do it this way, there's an opportunity cost doing it. So I, instead of saving money, that's just the way my brain works. So instead of me
Okay.
thinking, oh, I'm saving money by doing it this way, I think by not doing it this way, I'm spending more money than I have to.
Yeah.
Yeah, it's just
It's like in the negative.
it's the same thing. It's just I view it as, if you're not doing it, what are you doing? You know.
Yeah.
But I did the opportunity cost compounded over 10 years. So for that $40,000 income person, it cost them $70,000 over a 10-year period. The $100,000 income person, it cost them $91,000 over the 10 years. And that $300,000 person, it cost them $131,000 over the 10 years.
Is that like above? Is that, sorry, is that if they didn't
Yeah, if they don't,
structure it?
yeah, so if they don't structure it properly, and then I put that they would just take that amount and throw it into an investment, that's about what the account should be worth
Mm.
after 10 years of doing that
Oh.
every single year and just adding to it,
Hmm.
adding to it every year. So all that to be said, it adds up. The dollars add up, so it's a worthwhile pursuit. So there's a few ways to do it, but I just wanted to review two, like the most common ones. The one where, if you have the opportunity to do it, you should do it. It's not that complicated. Is basically, if you're choosing to have a mortgage and you have a non-registered account, any type of non-registered investments, even
Mhm.
if you had GIC, right? For the older clients, like if you're sitting on a $200,000 GIC and a $150,000 mortgage, you should be paying off your mortgage and rebooking a mortgage to borrow money to invest it. So I
Rebooking a
have,
mortgage?
yeah, so I have, and like taking out a new mortgage
Oh,
basically.
okay.
So I pay off I have $200,000. I pay off my $150,000 mortgage, and then I take a new mortgage out for $130,000, $170,000. You want a paper trail? I take that $170,000. I put that back into a GIC. Suddenly, the interest is tax deductible because I'm
That's
borrowing it to
crazy.
invest.
This feels very much like a loophole. Like it's just like you need to have things done in a certain order
Yeah,
for the government to be like, yep, that's good.
yeah, because you can't just have the money there and then just say, "Oh, it's borrowed to invest." It's like, no, you didn't borrow this mortgage to invest, so therefore not tax deductible. But
Right.
if
They
you
need to have the proof
have
of
to have
all
the
those
proof, yeah.
steps.
So, but if you pay it off and then borrow money to invest, tax deductible,
Hmm.
and it just has to earn an income, or expectation to earn an income. So buying like a commodity doesn't work. It can't be capital gains as your only expected return. It has to be income, so interest or
So you couldn't
dividends.
buy gold, is that what
Yeah,
you're saying?
correct. Yeah.
Give it, what's a capital gain
Capital gain is
exactly?
just when something goes up in value.
Okay.
So if you, for example, oh, that's way too complicated. Maybe I shouldn't do that one. You couldn't use this to buy a vehicle and then sell the vehicle again for a profit,
Okay.
and the interest suddenly be tax deductible. What you could do though, because this would be like borrowing money for a business, which you would expect an income, would be to borrow money to rent out a car to earn an income on a car.
So like rent a car and you're paying interest for renting the car, but you can write off the interest.
No, like buy a car and
Okay.
then rent out that car
Oh, I
because you're
see.
earning an income, like you're putting it into a business.
Right.
That's kind of where you'll see it more often. So but it's just remember that it has to be income producing. You have to expect an income from it. So if you're going to
Yeah.
be doing this and going down this route, this is something that you'd want to get a planning done around. Just, it can be messy if you do it wrong.
Yeah, it sounds like there
There's
is,
some pitfalls.
yeah, there's some complexity to
Yeah,
it.
just don't. And there's a few things like you don't want to then commingle funds, right? So we'll go through the other version, but something that people do is they'll do what I just said, but then they'll also they'll take $170,000 out, but $40,000 is going to a vehicle, and they invest what's left. It's like, don't do that. Don't be combing. Get a second mortgage on the same property. And you know what's great? Maybe people don't. Maybe people will know, but most credit unions, they do like a product called like a flex. What do they call it? Home, like the umbrella mortgage product that they do. what it's called. Connexus had it as well. I know Affinity has it. Like a bunch of our credit unions around, they have it. But basically, they just take a lien out of your home for a certain amount, and then
Yeah.
you can that amount they can split up however you like. So some
Oh,
people have like you can have two mortgages on there. You can have two mortgages and a line of credit. And
is
as
that like what we had for the Regina house?
no, no,
Okay.
no, not quite. No. Um,
Sorry, I'm trying to be helpful. I'm probably not.
it's okay. It's
Just keep
okay.
going.
It just means that you can. There's just some flexibility there, and there's just this one product works really really well for it because as you pay down your regular mortgage, and you can keep it separate instead of having to put it all into one and it be messy. It's
Yeah.
just very easy, and it's not more expensive to do it that way. It's just an easy way to do it. I was saying it. And
Yeah.
then the other method, which is a little bit more complicated, is something we call like cash damming or the Smith maneuver. And it's basically where it works really well for sole proprietors, people with rental income is the perfect opportunity for this. And basically, you take all of your income from whatever source it's coming from, and you use that to pay off your personal mortgage that's not tax deductible.
Okay. Yeah.
And then you take debt to pay for all of the expenses of that business or that rental property,
Okay. Yeah, that makes sense.
right? And that's in essence how you basically all you're doing. And then what will happen is let's say you have a bunch of rental property and you have like gross like rent coming in is $100,000 to keep it simple. That means that you can put $100,000 towards your personal debt, your non-tax deductible debt a year, and then all of the expenses, let's say that expenses come to $80,000, that $80,000 can be a new line of credit or something that is deductible debt. And so this
Dang.
isn't instant. It won't instantly take your $500,000 mortgage and turn it into a tax deductible debt, but over 4 years it will,
Right.
right? So,
Yeah.
and then once it's all done, you're there left with a tax deductible debt on your home because it's been borrowed to run this business so you can write off the interest now. And you have that until you pay off the mortgage, right? And so those type of things, again, it's just if you have the opportunity to do it, you should absolutely be doing it. Because
Yeah.
all it is you're just not, it's more money in your pocket, more money that you can save. Obviously, I'm going to say more money if you can save, but it's truth, it's more money. So you can spend it however you want to spend it. Even if you're not a saver, you should still be doing it. I would just recommend you save it.
Yeah. I'm just thinking about how, like, you're like, if you have the opportunity to do this, you should do this. But I guess maybe people who own businesses and who are in a different, like, who are entrepreneurs have more of a background and know these things. But I'm like, has anybody else not heard of the Smith maneuver? Or are we just like out here being like, oh, are you doing the Smith maneuver? Like this
What do you mean you don't talk about
strategy?
this?
Like, it feels like a game almost. Like you have to
Oh,
strategize and like, yeah,
most of finances feels like a game. Honestly, it's
yeah.
they
That's why you like it, probably. You're like,
right.
oh, I have to like
You should choose
figure
it.
out this
Yeah,
puzzle. Yeah.
that's and when you get to a certain point, that is really what it becomes. Is you're doing things to stack the chips in your favor. And for somebody that lives exactly the same life but doesn't do this, well, the person that did is $100,000 better off over 10 years, and that compounds. So over your
Mhm.
lifetime, you suddenly have $500,000 more to spend,
Yeah.
right? Just
Because depending
because,
what you do with the money, like
right?
you,
Like
it
it's
compounds over.
yeah. So that gap and that's what I think a lot of people don't understand is these decisions they compound. They all compound. All of these type of decisions. But this is an easy one that if you are, so I'll repeat it, like if you have rental property, if you have another source of income coming in that isn't like a salary type of job, you should be looking at things like this
Right.
pretty much across the board.
So like even people who have like a side hustle
Yeah.
or like stuff like an Etsy shop. Of course, I'm saying these things because
Yeah, 100%. If you are a sole proprietor, if you're set, yes, absolutely, you should be, and you have a mortgage still, and you should be looking at options like this. because you might have taken that debt. Let's say you're doing this for 3 years and you only do it during those 3 years. Well, that's 3 years now of debt. Everything that you could put on there that is now tax deductible for the rest of your life until you pay it off, right? So
Yeah.
yeah, the doing it right at the beginning makes a big difference.
Yeah.
Why would you risk that, right? Like, why would you
Yeah.
miss
Don't
why
wait.
would you
Like,
don't wait. Just worst case scenario, the business doesn't work out and you're still in a fine position. Like, like it's just, yeah, one of those things that it does compound over time, but it's a pain to do. So, and if you're not systematizing your finances the way that like, I would teach somebody to, it would be a pain, right? Like, it's, yeah, it would just be a pain. So for us, it's like we could do this and it not require any more mental effort because I would just automate it every single month and
yeah,
run two
you'd
different
figure it
accounts.
out,
And
and
yeah,
then yeah,
like, and so I have to sit down once, do it, and then don't think about it again. That's how I like to to operate. So yeah, these type of maneuvers, they are a pain to. And if you're already swamped with complexity for your own and you can't even budget properly, then this is going to be too much to, or you're going
right.
to screw it up, right? Like, because it's like, yeah,
Like, are you saying, but that's if somebody's trying to figure this out by themselves? Is that what you're saying? Like, versus
yeah,
like,
but
oh,
even
I'm
if,
gonna pay an advisor to do
yes, but
maybe
then they
even
still have
like
to
an
stick to
hourly.
it, right?
Right. I
Right. So
see.
I can say to somebody as I'm blue in the face, don't commingle these funds. And then they go and buy a boat. Well, enjoy the last 10 years. Yes, technically you're right. Technically you're able to do that. I don't really, well, let's see what the CRA says if you get audited. Like
Yeah.
it's suddenly not so, it doesn't, if you're being audited by the CRA, they are looking for something and they'll probably find something.
Yeah.
So it's a case of why give them that? Do it by the book. Do it properly.
Yeah. If you're gonna play the game and optimize everything and strategize, then play the game by the rules. Don't
Yes,
start messing things up.
exactly. And
Yeah.
that does take discipline. That take like, that like a lot of
Yeah.
things that you have to. So yeah. So what I would say is if you are looking at this, just make sure you have very clear documentation, make sure you get there and go and see the appropriate advisors for help. This type of thing, depending on the complexity of it, I often will talk to their accountant and stuff to bring them
Like
into
more
it as well. And
information.
like it's one of those things that it's worth it to do the work up front. Don't half do it because it's easier. But at the same time, it's part of the game. So if you're gonna try to optimize and you're gonna try to be as efficient as you can, and then you have to learn to do it. I
Yeah.
mean, that's what we do. And I don't keep the money separate to know exactly what the dollar figure is, but I bet you it's significant of what we've been able to save, etc. Just because we do it in as efficient a manner as possible, right? So
I feel kind of bad being you keep saying we. You're like, that's how we do it. As you're telling me about this, I'm like, wow, this is brand new information. Hopefully. I mean, I
the
listen,
royal we, okay.
listen. I let Trey take the lead. He teaches me things. Sometimes my brain can't store it all. So I'm just
We've
saying
spoken about this. We spoke about this years ago, but
I know, like that's the thing. I know it's just some things just don't stick the same for me. So anyway.
yeah. But this is one that's commonly missed, especially if you're depending on the type of people like the type of person you're getting mortgage advice from or whatever. So this is just like very low hanging fruit. So again, I repeat it one more time. You have rental property, or if you're a sole proprietor, absolutely you should be thinking about this.
Mhm.
Um, and if you even easy, if you have a non-registered portfolio and still have debt, this is a no-brainer. This is absolutely you should be doing this. There is zero downside. I mean, you will have to like go through for example, if I'm doing this with somebody, it is technically a leveraged investment. So that comes with more risk.
Mm.
Technically.
Hectic. Yeah.
Technically, that is true. In reality, your financial situation hasn't really changed a whole lot. You just now can write off the interest.
Mm.
So it's like, even if you're even if you're not the type of person that's like, okay, I don't want to borrow to invest. That's fair. You're already doing it. You might as well get the advantage of doing it, right?
You might as well
We
get
we
the
already
benefit.
know the numbers show and prove that it more often than not, it's better to invest than to pay off lower interest lower interest debt. It's more often than not the right decision not to pay down your mortgage. And now the Dave Ramsey's out there, got the name right this time, would disagree wholeheartedly, etc., etc. But numbers don't lie. So, but
Yep.
again, it's only right for a certain type of people that really is trying to optimize and stretch their dollar as far as
Possible.
right, like far as reasonably possible. Anyway, that's what we'll leave it there. Did you have any questions that you think the audience would ask? Do you have any questions that you think the audience would be asking?
I don't think so. I think I'm pretty. I mean, with you, I'm pretty good at asking as you go. I'm like, wait, what? What's happening? So
Okay,
hopefully I asked enough questions. But
perfect. Then we will see you in the next one.
bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.